You know, when you look at a company's financial report, what are you really seeing? Is it just a wall of numbers? Or is it more like a patient's chart, filled with vital signs that tell a much deeper story about its health? Well, today, we're going to put on our lab coats and do a full financial checkup. We're zeroing in on the corporate giant UnitedHealth Group, and our main diagnostic tool is going to be their latest earnings call. Specifically, we're listening to what their chief financial officer had to say to get the picture straight from the source.
All right, first things first. Let's check the company's vitals. We're diving into the key numbers from the third quarter of 2025 to see how UnitedHealth is doing right here, right now. And wow, the first number we see is an absolute headline grabber, over $113 billion in revenue. Just to put that into perspective, that's a 12% jump from the same time last year. That is some seriously healthy growth.
So where's all that growth coming from? Well, a massive customer base. UnitedHealth Group wrapped up the quarter serving over 50 million people just here in the United States. That's a huge number of patients, so to speak.
All right, let's talk about the bottom line. Their adjusted earnings per share, which you can kind of think of as the company's profit for each slice of the ownership pie, clocked in at $2.92. That's actually a little better than Wall Street was expecting. So far, this patient is looking pretty robust.
Okay, but here's where the diagnosis gets interesting. Take a look at the medical care ratio. This is basically the percentage of premiums they're spending on actual medical care for their members. As you can see, that number has shot up from about 85% to nearly 90% in just 1 year. So yeah, revenue is way up, but their costs, they're rising even faster. In our checkup, this is a clear sign of a rising fever, a major pressure point. So, with this cost fever getting higher, what's the CFO's prescription, right? What's the treatment plan to make sure the company stays financially strong for the long haul?
Well, the treatment plan all starts with this one metric called the debt-to-capital ratio. And really, just think of it like your own personal finances. It's like comparing how much you owe on loans and credit cards to all your savings and assets. You want that ratio to be low, and that's exactly what UnitedHealth is shooting for here.
And this right here is the game plan, laid out nice and clear. First, they're hitting pause on any big spending, so no major company buyouts or stock buybacks for a bit. Then, all that extra cash they're generating is going straight to one thing, paying down debt. The goal is to get that debt-to-capital ratio down to a much healthier 40%, and only then, in the back half of 2026, will they get back to their usual spending and investment strategy.
And look, this isn't just some internal accounting mumbo-jumbo. This is a huge signal to the market. The company is basically telling everyone that they're choosing financial stability over flashy short-term moves. They're battening down the hatches for a potentially stormy year ahead.
So they've got this defensive plan in place. What does that mean for 2026? What's the prognosis here, according to the CFO?
The CFO basically laid out 2026 as a year of competing forces. On one side, you've got the headwinds. These are the big challenges pushing them back. But on the other side, you have the tailwinds, the opportunities and smart moves that could propel them forward. It's going to be a real tug-of-war.
And that biggest headwind? Wow, it is a doozy. It's the final year of some major Medicare funding cuts, and the CFO put a number on it, a massive $6 billion challenge. That's not just a headwind, that's like a hurricane. Now they're hoping that the tailwinds, things like repricing their plans and getting more growth from their Optum division, will be enough to help them power through that storm. Okay, we've reviewed the vitals, we've examined the treatment plan, and we've heard the forecast. So let's put it all together. What's the final diagnosis on UnitedHealth Group's financial health, based on what the CFO told us?
So here are the big takeaways. First, the company's growing like crazy, but that growth comes with that nagging fever of rising medical costs. Second, their whole strategy for 2026 is defensive. It's all about building a financial fortress by slashing debt. And third, they know they're sailing right into some major headwinds. But they've got a clear plan to navigate the storm and set themselves up for much smoother sailing in 2027 and beyond.
And all of this leaves us with one big question to chew on. Here we have a company that's deliberately slowing things down, taking its medicine and bracing for a tough year, all for the sake of long-term stability. So the question is, in today's world that moves at lightning speed, is taking this kind of short-term pain the right prescription for long-term gain?